you can see why there are no gold treasury companies or real estate and gold are hard, is because they don't outperform the S&P. It's a little bit challenging. But to the extent that you make money in real estate, you can see the way you do it is you lever it 4 to 1. Right? When you look at that chart, if you can lever real estate 2 to 1, 3 to 1, 4 to 1, 5 to 1, 10 to 1, right? Then you could probably make money. Nobody's figured out how to lever gold. This is the last year. And you can see, Bitcoin's up 100%. How do we measure success? Well, our business is to generate additional Bitcoin per share every year. So if you're buying strategy stock, you own a certain amount of Bitcoin, and then we add more. Last year, we added 67,000 Satoshis per share. And then this year, we've added 41,000 Satoshis per share. So you're making money by increasing the Bitcoin per share, and then the Bitcoin price is going up. But ultimately, the difference between a Bitcoin treasury company and a Bitcoin ETF is an ETF like BlackRock's going to have a certain amount of Bitcoin, and you'll lose 20 basis points a year. That's the fee. You're never going to have any more. But an operating company, you'll have a certain amount of Bitcoin, and then you'll have more each period thereafter. And we call that increased BTC yield, Bitcoin yield. And so this year to date, we've had 25.8% increase in Bitcoin per share, right? Our target was 25% for the year. So if a company said, well, we're going to increase the share of Bitcoin, the amount of Bitcoin you have per share by 25%, and then you would think, well, it's worth a premium to the underlying asset. So you're valuing the company at a premium to the reserve because it is accreting Bitcoin through its operation. For the longest time, ExxonMobil was valued at a premium to its oil reserves on a similar logical basis. Here's a snapshot of our business model. On the left side is the crypto economy. We start with Bitcoin. It trades 60 to 70 billion a day. It's this long duration, volatile, high energy, high performance, very scary asset, and it's global, and it doesn't stop. And the traditional finance economy doesn't want it, can't buy it. What they want is they want an equity or an option or a credit instrument in a wrapper that they can deal with. So if you buy just wrap Bitcoin, you're buying IBIT, which is BlackRock's big ETF, and that's been very successful. But what you'll get is the volatility, the duration, and the performance of Bitcoin. What we've done is create credit instruments that strip the vol, strip the duration, strip the risk, strip the performance off of it, and we sell that as a convertible bond or a convertible preferred or a fixed long duration preferred or this stride instrument, which is a non-cumulative preferred, or the latest thing we did, which is Stretch, which is a money market. Strike is structured Bitcoin. I'm going to give you the upside, downside protection, and a guaranteed dividend while you're waiting, right? So think of it for more conservative investors. They don't want the roller coaster ride. What they want is like a guaranteed 8.4% yield, and they want to be senior over collateralized in the capital structure, and they want like a 35-40 delta instrument. They'll get 40% of the upside of MSTR stock, but they won't be getting the downside, and they give up that performance for that principal protection. What's Strife? It's long duration credit. It's like a perpetual bond, and so if you want a certain yield, you want 9% yield for the next 100 years, that's what you want. That's, it's effectively 12, 14-year duration, which means that if SOFR dives, you're going to want to own this because this thing is going to be yielding 9% when SOFR is 2% or 1%. So it's like 100-year bond. Way over collateralized, 7.6 times over collateralized in BTC. A mortgage-backed security is 1.3, 1.5, right? So the perception is these things are risky, but the reality is they're not, they're the most over-collateralized credit instruments in the market. Stride, it's high yield credit. So we're aiming that at the junk market. It has a 12.7% effective yield, but it's nearly 5x over collateralized. So loan to value would be like 20%. You've got $5 of Bitcoin for every dollar of this asset that's issued. If Bitcoin were to crash 80%, you're still collateralized. If you think Bitcoin's going to go to zero, you don't want to buy any of this stuff. But if you actually think Bitcoin is just volatile and it may go up and down, then all this stuff is within your wheelhouse. And what is Stretch? Stretch is the most aggressive piece of financial engineering we've done, because with Stretch, what we did is we took that 120 months of duration to 1 month. And the idea was, I don't want volatility, I don't want principal risk. All I just want is something that pays 400 basis points or 500 basis points more than my bank account, and I want the money back when I ask for it. High yield bank account, high yield money market. So we target price stability 100%. And of course, if you walk down the street and you say to 100 people, do you want a 30-year Bitcoin bond that yields 9%? You know, you get like 1, 2, 3 out of 100. But if you say, would you like a high yield bank account that pays you 10%? Well, that's like 95 out of 100. Everybody wants their bank to pay them 10% instead of 4%. Why do we trade at a premium? Why do we exist? What is the logic of a Bitcoin treasury company? Well, it starts with credit amplification. You need an operating company to sell credit. The world wants credit, right? The credit amplification gives the equity 2 to 4 times the performance of the underlying asset. That creates the options advantage. You end up with a much deeper, more vibrant options market. Then you're able to tap into passive flows and institutions. Now, how important is that? These are the global credit markets. Take a look at that. 75, $90 trillion. You get 4% yield in the US, you get 2% in Europe, you get 1.5% in Japan, you get 55 basis points in Switzerland. The credit markets are sick. Like, they're not healthy. These people are yield starved. It's getting worse. Right? So selling the credit is like, well, how much are you going to sell? Well, take 1% of that is $800 billion worth of credit instruments. So the market is massive there, and they all want to be paid 400 basis points more than that number. How important is passive indexed money? There's $17 trillion of capital in passive funds. 85% of it is equity indexes, 15% is credit indexes. Nobody thinks that long-term capital is investing in a commodity index. The commodity index funds are 0.1%, 10 basis points. That is to say, every commodity other than gold or silver is a dog. And anybody in gold or silver is not in an index fund, they're in gold or they're in silver. So, what's the significance of this? The indexes, the credit index need to buy credit. The equity indexes need to buy equity. There's $17 trillion. This is my shareholder space. Look at the top 100 shareholders. 57% of the shares are held by passive indexes. So Vanguard, BlackRock, 2 of my 5 biggest investors, they're passive. They're not active. Only 43% of those shares are held by active managers. Now, that's just a sample of the top 100, but the top 100 cover 46% of the company's shares. What that's telling you is there's going to be a substantial flow of credit and equity capital to Bitcoin treasury companies, because this is not going to unwind itself. People aren't going to wake up and say, oops, I think I should just not allocate to the S&P or the NASDAQ 100. So this is structural. And this is structural. If you look at managed capital, 60 trillion is credit, 35 trillion is equity. Only 3 trillion is commodities, but the commodities are mostly gold held by central banks. They're not selling. So ultimately, you have maybe $700 billion of capital that might find its way into a commodity like Bitcoin. The world wants equity and credit. And the only way to create equity and credit is to take an operating company public, build a huge capital base, a big equity base, and then start to tranche off, BTC 10 rated, 5 rated, 3 rated instruments. And, if you ever seen like a big block of lucite and a computer generated milling machine, you put your image into the computer and it mills it out of the lucite, you get this beautiful sculpture. That's what I think when I think about what we're doing. We take a block of digital capital, Bitcoin, we take digital intelligence, and we design a preferred security. You tell me what yield, what duration, what kind of risk, what collateralization, what do you want it to look like? And we generate the digital credit from the digital capital. We sell it to the market, and we can sell it as much as the market wants to buy. You want to buy 500 million right now? I sell you 500 million right now. I will create it on the fly. You want to buy 5 billion? You want to buy 50 billion? Right? We have certain rails, like, at some point we'd be under collateralized. So I can't just, slam it to a BTC rating of 2 overnight if it's supposed to be a senior instrument. But to a much greater degree than any issuer of credit in the modern world, Bitcoin treasury companies, especially a well-capitalized one, can create the most compelling high-performance credit instruments and do it fastest and quickest. And that's what the market wants. So I'll just end with this slide. Our principles are simple. We buy Bitcoin, we hold Bitcoin, we're exclusive. We want to be homogeneous credit risk. We want to be homogeneous in our capital strategy. We prioritize long-term value creation for the equity. So everything we're doing, I hold the equity, look out 10 years. Is this a good idea for 10 years from now if I'm an equity investor? We ask that question. We treat all of our investors with respect. If we told you we're going to do something, we do that thing. We structure the equity to outperform Bitcoin. If we can do 2x, we'll do it. If we can do 3x, we'll do it. If we can do 1.5x, that's what we'll do. And then we continually acquire Bitcoin as long as it's accretive, right? There's none of these transactions are ever dilutive. We're always generating yield. We're always selling securities at a premium to the underlying asset NAV. And then otherwise, week by week, day by day, we react to the market. The credit markets, the macro markets, they're changing all the time. They can change from the morning to the afternoon. I've seen them change from the point that Jerome Powell starts a press conference to when he finishes answering questions. They'll go this way and that way twice. We're reacting to that all the time in all of our capital programs. And, ultimately, we don't have to do anything. We have the option to just do nothing for 3 months or 6 months. And if we did nothing, we have a $72 billion company growing 50% a year, which is just about better than anything else I've ever seen in this market. So our default is not bad, so do no harm. When we see an opportunity to do something good, we do it. And in the meantime, we promote global adoption of Bitcoin as a treasury reserve asset. And why? Because I think all the companies in the world are type 1 diabetics. I think they can't retain their economic capital or energy. And if you want your company to live forever, or you want to live healthier or happier, then you want a capital asset that allows you to retain your cash flows and grow your shareholder value without surrendering capital. It's a very simple idea, but it's a powerful idea that'll work for a private company or a public company. And if you've ever seen a great company brought to its knees and torn to pieces because it was undercapitalized, or you were on the receiving end of that situation as an investor or an employee or a customer or a constituent, then you understand what I mean.